Welcome to another episode of Frugal Finance. Today we're going to be looking at the mid-week pie review. So the dividend pie that I've got, we're trading 212. That is basically just chuck a load of money in there and you'll get a small return, but also some dividends on a daily basis. So let's flip on over. But before we do that, if you could just smash the like button down below. It's a tiny little button down here, little picture of a thumb like that. Basically, if you just give that a little click, that lets YouTube know that you like the video, and then it might pump it out to people that like similar videos or maybe be interested in this at all. So as you can see, we're just chilling here whilst I film this particular video, so on this lovely evening. So without further ado, whilst we can have a nice little panoramic scan of the harbour here at Seaford Town, or the bay, even the harbour. I mean, the harbour's all the way over there, but either way, let's get stuck into the video. So we'll just load up the Trading 212 app and we'll go straight on into the pie once it's connected. I just sometimes have to wait a little while. So quickly, first of all, we'll flip on over. Obviously, there we are, Neo not doing so well today. That might be a bit of a theme, who knows. So overall portfolio is up to 0.24%, so it's pretty flat. So let's nip on over to the pie. So the pie is actually up 4.51%. Now we'll get on into the holdings here to see really why that return is looking quite healthy compared to the normal stocks and shares that I hold. So as you can see through here, without a kind of micro analysis of each individual stocks, some are down. Nothing is specifically holding any real minuses, but generally quite a lot of green stuff. Now, the reason I believe for this, to kind of cut the story short, because we could spend quite a long time microanalyzing all of these various companies, and this essentially is the passive income dividend pie, so we're trying to make life easy here. But basically, this pie acts very much like an ETF in that you spread your funds over quite a thin amount, so it doesn't fluctuate quite so much. And these companies, generally, they're quite stable companies, because they're paying out a dividend, so they're actually kind of matured. They've sort of, in generalization, it's not quite like this, but they have gone through their growth stage, if you like, and settled down, and really now they're into a kind of a dividend paying stage. So they're a mature stock, if you like, which is why you don't see companies like Uber, Tesla, and PayPal and those kind of companies in here, because they haven't really matured into these kind of long-term dividend paying stocks. Now, you can argue that companies like AT&T are a dividend trap, because generally speaking, their prices kind of go down a little bit, and people are obsessed with the dividend because they pay out quite a healthy one. And also, some people will argue that if companies got nothing better to do with their profits than give them back to the shareholders, then that's maybe not good management. So they're not investing in the future. But you've got to remember that a lot of these companies are giving back maybe even less than 1% of their net worth or their profit, and as such, really, it makes up a very small amount. I mean, Apple, for instance, gives 0.68% back of its profits. So it's really very little, and obviously they're using this investor fund to to grow their business. So they're looking for capital investment, and then back from that they become dividends, which obviously portrays a very stable company. So I believe that is essentially why we see such good growth for this. So 4.46% in comparison to, say, oh, we just earned another 63p there. 4.46% is, a reasonably good return at the market at the moment. It's on another bit of a downturn. It's having this sort of double dip, as everyone keeps referring to it. But, I think the market's just very volatile at the moment. There are a number of factors for that, which I've touched upon in other videos, and I'm sure You can search YouTube and find them. So anyway, that is the dividend pie for this particular week. I did credit some money into it. I tried to do that on a regular basis. It's been a bit of a hectic week, and I was going to put actually some a larger amount of funds in there, but I've actually needed to commit to a purchase of a property and a transfer from personal name into company name, which I'm going to do a video on, and the pitfalls and things to avoid with that, because it's been a bit of a learning curve for me on that one. So with that said, if you do like the video, please smash the like button. Don't forget to subscribe. That really does help with the YouTube algorithms. If you'd like to start your investing journey, there is a link in the description below to Trading 212. They are extremely busy with new applicants at the moment, so I suggest you get in there and get in the queue if you are interested. They won't be able to process your account straight away. They're just inundated with people. But if you use the link, you do get a free share up to the value of £100. So why on earth wouldn't you do that? It's £100 or up to £100 potentially for nothing. And finally, as I say in all the videos,
these videos are for entertainment purposes only. I'm not a licensed professional. I'm just a guy on YouTube, and you should take everything I say with a pinch of salt. Investing your money into the market may mean that it is at risk. You should seek independent professional advice if you decide that you need to invest into the stock market and you're untoo sure what you're doing. So the point of this little small print, if you like, at the end is literally just to reiterate the fact that these videos are for entertainment purposes only. You need to do your own research. So don't listen to anything I'm saying as advice. See you next time.